All right, good morning, everybody. We should be up and running live on our monthly market update. Thanks so much for joining us today on our final market update for the year. I have Urmi Desai joining me as well from Realosophy, our editor at Move Smartly. So she's going to be keeping an eye on your questions. So please feel free to share those. Let's see here. If you have them in the chat, let me pull up my screen here. I'm having issues with my, let's start again. Sorry about this. Technical challenges with our Zoom setup. There we go. All right, back up and running. Okay, so again, this is John Pasalis from Realosophy, from Move Smartly. We're going to be chatting about a number of things today. We're going to go over our December market update for houses, our market update for condominiums, going to chat about some of the trends on the ground that we're seeing. Then I'm going to go into some things that we're seeing, some red flags in Toronto's pre-construction low-rise market. Last week, I chatted about some of the things we're seeing in the condominium markets, but we're going to chat a little bit about the things that we're seeing in the low-rise market as well. We're going to chat a little bit about a foreign buyer ban in Canada that was just coming up, actually, and announced by the federal government. I'm going to talk a little bit about some of the financial stress that we're seeing on the ground right now. And then I'm going to finish up by taking a closer look at Toronto's rental market in a little bit more detail. So if you have any questions, please post them in the chat. Urmi's going to be keeping a close eye on those, and we'll go through those as we go through some of the latest trends. If you have any more specific questions, as always, you want to set up a private meeting, a custom meeting with me, you can just go to movesmartly.com/meetjohn to set up whether you're buying, selling, consultation. I mean, or if you just are curious and have questions that are a bit more specific about your specific situation, about what's going on. All right, so we're going to move on to the market for low-rise houses, and we're just going to chat on some of the broader trends. And the one thing I'll say is not much has changed since September. The market's been pretty balanced. I've been seeing some very odd comments about the data, on Twitter, where I'm pretty active. It's like people don't understand the trends that are important. So I'll try to unpack some of these. And right now, I mean, the big trend, of course, is that sales are at a 20-year plus low level. I mean, sales are down 47% over last year, but the bigger point is that they're at historic lows. We haven't seen these numbers probably since the early 2000s. And again, sales are largely this low because it's a lot harder to buy a home today. I mean, people are getting stress tested at an interest rate that's probably closer to 7% versus 5.25% at the start of this year. So that's weighing on demand and certainly impacting the buyers who are out there. Listings volumes are down about 13% over last year, still below kind of historical norms. And inventory levels are actually more than double what they were a year ago. And this is kind of one of the things I've seen people comment on, that this is, the canary in the coal mine. This is a sign that the market's tanking. But it's quite wrong. I mean, normally, yes, inventory levels doubling would be a red flag, but they're unbelievably low last year, partly because we were in this bubble that was accelerating towards the first quarter. So we're comparing this year to what is a historic low last year, partly because demand was so strong. So inventory levels right now on the ground are actually not that high. And that's actually one of the reasons why prices have been pretty stable. And we can kind of see this more accurately if we look at this metric called the months of inventory, which compares sales to how many homes are available. So, if there are 100 homes available and 50 homes sold that month, then we have 2 months of inventory. But if there are 100 homes and only 10 homes sold, we have 10 months of inventory. So months of inventory has been stable pretty much over the past 4 or 5 months at just over 2.3 months of inventory. which is relatively balanced right now. Again, the things that we look for are big changes in inventory levels, like that big spike we saw from in the first half of this year when we had less than a month of inventory, went up to nearly 3 months of inventory. That's really when prices fell. But right now, inventory levels are actually quite stable. And one of the reasons, if we look at sort of a price chart, prices have also been flat since July, which quite frankly is quite interesting. If we look at low-rise prices, we've dipped from a peak of around just under 1.7 to around 1.3 today for average low-rise home prices, which is, a little bit below where they were a year ago, and well above still where they were sort of pre-COVID. But at the end of the day, right now, we've seen some stability in prices, which again, I think is interesting and partly driven by the fact that inventory levels are still quite low. When we look at the condo market, slightly similar trends. Again, sales for condominiums are again at historic lows, like, down 54% over last year, but more importantly, way below historical levels. New listings are a little bit down, but again, in line or a little bit below kind of historical levels. Inventory levels, on the other hand, for condominiums, active listings, I should say, are above, sort of well above past couple of years. They're below 2020 because in 2020 we had this sort of boom of listings. But again, when we look at the months of inventory, it's been pretty stable over the past few months. We've had just over 3 months of inventory for condominiums. And this has led to some stability in prices for condominiums as well. I forgot to mention now that like low-rise houses were actually down 11% year over year, because we're starting to get to the point where we're going to start to see double-digit declines as we move to February. Condo prices didn't accelerate as much, haven't declined as much. We're down maybe about 13% from the peak, but they've been flat over the past few months as well. So we've seen a little bit of stability there. Now, I'm just going to chat a little bit about some of the on-the-ground trends. Again, it's an interesting market. I mean, again, it's sellers are pretty stubborn. Many of them are sitting on their prices, aren't moving. Buyers are some of them are just getting just very eager, because a lot of the buyers who are active right now just need a home, quite frankly, right? And if they're not finding a lot, they're jumping on and bidding aggressively on the ones that are for sale. And, Davin, who's an agent at Realosophy, kind of sent me this text a while ago, and he was helping a client, and he actually said, trying to run comparables on some of these is insane. Some sellers are taking too little, and some are still getting far too much. And what he means by that is, when we have a client who's looking at buying a home, we try to find comparable sales that are similar to the home that they're bidding on to kind of figure out what the right value is. But the market is all over the place. There are some homes where the sellers are just eager, want to move on. They're not getting a lot of showings, not getting a lot of offers. So as Davin's describing, they're selling for less than what they should. And some homes, usually the nicest ones that are staged, that look amazing, are selling for more than they should, kind of like above what is theoretically market value. And again, we've talked about this past sessions. This is largely driven by the fact that, most buyers are gravitating to the nicest, prettiest homes that come up every single week. So those ones are getting aggressive offers. The other homes that are not as staged, aren't as perfect, are not getting quite the volume of offers and the prices that some of those other homes are getting. So these are the trends we're seeing now. Again, how this unfolds as we move into the new year, I think, is going to largely depend on inventory. Most people don't realize that January, February are usually the most competitive months of the year. Everyone thinks it's the spring because that's when the most highest number of sales. But usually, historically, January, February has always been the hottest months. And by that, I mean like the highest number of offers per home, the most competitive. And that's largely because if you think about how a lot of people buy homes, a lot of people kind of hit pause, even if they're active now, they hit pause in this holiday season and then start again in January. And then new buyers usually jump in January, February, planning to buy a home this spring. So you have this rush of buyers entering the market, but very few listings. And it ends up being very competitive. I don't know if those dynamics are still going to be the same in the new year, because obviously the economic conditions are quite different. But I suspect that, we're going to obviously probably see a typical seasonal increase in demand from buyers. What we don't know is what inventory levels are going to be like, and more specifically, new listings volumes as we move into the new year. So before I kind of move on, I don't know if we had any questions to go over, Urmi.
Yes, so just a request for a clarification. On low-rise houses, I think specifically what the prices are now compared to February.
Yeah. So average low-rise house prices right now are around the 1.3 million range. And they've been that range since around July. They peaked in February at just under 1.7. And I believe, I'm just looking now, pre-COVID, I think they were very close to 1 million. So we're still, there was two waves of this acceleration in home prices during COVID. The first was in 2020, right after the lockdowns, things accelerated at the end of 2020 and the first few months of 2021. And then things actually flatlined for like 6 or 9 months. And then we had this other boom in prices at the end of 2021, beginning of 2022. So we kind of lost that growth between 2021 and 2022. So we're actually now kind of getting to the point where we're down year over year.
Great. Okay, there's a lot of good questions coming in. I'm going to hold some of them after the next part of the discussion, because I know you're going to go into a little bit of detail around pre-construction, and then we'll move out to more general questions at the end.
Okay, sounds
a lot of these issues are intertwined. Yeah.
Beautiful. All right. So I didn't put this in my report, but it has come up since then. And I wanted to chat a little bit about some of the issues we're seeing on the ground in Toronto's low-rise pre-construction market. So last month, I chatted about some of the red flags we're seeing in the pre-construction condo market. And that has to do with, buyers getting financing and having a hard time. But the issues with low rise are actually more significant, because many of the people who bought the low rise kind of completion cycle is a lot shorter. The person who's going to take possession of a condo today bought it 5 years ago, right? So they've had 5 years of potential appreciation. Someone who's about to take a possession of a pre-construction low-rise home, like a detached or semi, likely bought it, 12 or 18 months ago. So they were buying during that COVID boom. And what has happened is many of these buyers, for those of you who haven't seen it, there's been, most people are starting to protest, because a lot of these buyers bought their homes in late 2021 and early 2022, and they've seen the values kind of decline. And I'm going to walk you through what that looks like and how that impacts people. And as I go through this slide, I realized I should have done an animation, but I did not. So we're going to have to go with it. And I'm going to kind of walk you through what this looks like. So imagine you're a buyer and you bought a pre-construction home in February 2022 for 1.8 million, right? Well, fast forward to today, and let's just say that price is down 30%, which, in some cases it is in some areas. Well, that home now is only worth 1.26 million. So you've lost $540,000 in value. And the problem many of these buyers, whether we're planning to move into it or investors, is pretty much irrelevant. What's happening right now is when they're trying to get a mortgage, the bank is saying to them, sure, we'll give you a mortgage, but we're going to give you a mortgage assuming the home is only worth 1.26 million, not the 1.8 you've paid for it, which means the buyer theoretically has to have a 20% down payment for the 1.26, but also have an extra $540,000 to cover the difference between the price they agreed to pay and the value that it is at today, right? And this is the one thing that makes buying pre-construction completely different from buying a resale home. And most people don't realize this. And I've been, trying to educate people about this and the risks sometimes, especially over the past couple of years. When you buy a pre-construction home, you're not buying a house. You're signing a contract that obligates you to buy a home in the future at the price is set today, or in this case, in the past, right? Which is very different, because if I had bought this home in February 2022 for 1.8 million and I moved into it and got my mortgage, and yes, the value dropped 30%, that would suck, right? Because my home is now worth only 1.26, but I paid 1.8 for it. But if I just keep paying my mortgage, I can just wait for the prices to recover, even if that takes 10 years. I'm not kind of ruined financially. Whereas pre-construction is very different, because you have to have a lot of cash to close, right? And these buyers don't have this extra $500,000 to cover the difference between what they paid and what it's worth. And what's even worse than that, I should add, is that many of these buyers, let's just say they're not investors, which I suspect many are. There are a ton of investors buying pre-construction houses, but let's just say they're not and they are end users. Well, most people who buy a pre-construction home that's scheduled to be completed, say a year from now, will sign the contract, commit to buying it, but then continue to live in their existing home and wait until a month or so before they're about to take possession of their new home to sell their current home on the market. And the reason a lot of people do this is because they don't want the inconvenience of selling now and moving to a rental while their new home is being completed, but also because they expect their current home to increase in value over time, right? So let's just say I'm this pre-construction buyer and I bought a $1.8 million home that is declined now, $540,000. And also I own a $1.2 million home. At least it was worth $1.2 million in February when I decided to upsize. But fast forward, 10, 11 months, my home now is only worth $840, right? It's also dropped about $300,000+, or 30+%. So the value of my home, which I was going to use the equity in to buy the next home, has dropped $360,000. So if I am this homeowner, between the decline in value of my existing home and the pre-construction home I bought, I'm down 900 grand, right? And this is what destroys people's wealth overnight. And this is not new. This is a headline from 2018 from the Toronto Star about buyers who were in very similar positions, who bought homes during the bubble in 2017 in the first quarter at the peak. And then fast forward a year, prices were down on the home that they lived in and the home that they bought. And of course, they didn't have the hundreds of thousands of dollars to cover the difference. And as the headline says, they faced financial ruin. So these are the risks with buying pre-construction. I talked about on Twitter how I caution a lot of people about this stuff, but very few really care. I mean, we had a client who bought pre-construction low rise. They sold their home at the peak of the market. I mean, they didn't know at the time it was going to be at the peak, but they wanted to mitigate that risk, and they're in a far better position. But the vast majority of people don't do that and don't think like that, and probably are going to find themselves in this situation where they're out. And I should add, before we kind of go to the questions, if you're that buyer, the builder, for the most part, usually has every right to sue you for the loss in value. If you don't close, if you don't get a mortgage and can't close on that home that you bought, they can go after your home. They have every right to sue you. And the vast majority of the time, they're going to win. And the buyer is going to lose, because the buyer committed to the contract. The buyer gets the benefit if the price goes up since the time they bought, but they also take the risk that the value might decline since the time they bought. So this is why a lot of people are in difficult situations right now. So on that, I'll pass it to Urmi. I don't know if we had any questions about this, given how timely it is. And
yes, we do. I think there's some good questions that fit in here. So just to clarify, John, are you seeing this kind of issue across pre-construction segments? So both low-rise houses and condos?
So it's a bigger, like I said, it's a bigger issue for low rise, because many of the low rise have a shorter construction cycle, right? for pre-construction, many of the people who bought pre-construction that are supposed to take possession in the next 6 months, most of those bought 4 to 5 years ago, before this rapid acceleration. So those people, even if they're having trouble getting a mortgage, they probably haven't seen a big enough decline or a huge decline in the value of the property, right? Their issue is, I just can't pass the stress test. So I have to find some way to unload this thing, right? Now, there are some buyers, and we chatted about it in last month's episode, who bought into a project late in the development. So like the development started in 2018 or early 2019, and these buyers bought in mid 2020, you know what I mean? And the project's going to be completed in the next 6 to 9 months. Well, those people probably are at risk of not only having a hard time getting a mortgage, but because of the stress test, but also because the value has likely declined because they bought so much closer to the completion date, right? But it's certainly a bigger issue for low rise for these, because the low rise housing market we have to think about is the area where prices have seen the biggest decline. If we just go even back to the statistics at the start of this session, low rise home prices are down like 23, 24%. Condo from the peak, condos are down like 13% or something like that, right? So that's partly why it's a bigger issue. I mean, there aren't as many low-rise pre-construction homes, so it's not as in terms of economic and systemic risks, it's not as big as if this was happening in the pre-construction condo market.
Okay, and to follow up on that, just a little bit more detail. I think you've answered it, but a question from Zaid, I hope I don't know which pronunciation is correct, is whether.
Yeah.
Sorry?
Go ahead.
Oh, yes. Whether we will start to see distress sellers in this segment the low-rise segment, as opposed to, let's say, condos, and specifically the low-rises in, the larger homes in King, Aurora, so those are in Yorkville region, Stouffville, which is also in York region, sorry.
So I'll chat a little bit about potential distress coming up as we talk about sort of the financial pressures, but this is different because this is in some ways certainly distress, but this is distress among households who have bought pre-construction, who can't afford to close, who might get sued by the builder. It's quite different than than the traditional recessionary high interest rate distress that we'll chat about and we're hearing about households who can't afford their higher mortgage payments, who can't afford their debt loads, things like that. It's very different. So I think that the dynamics will be quite different.
Okay, so let's get into more detail on that then. And I'm going to hold some of these other questions because, again, they're so intertwined that I'll hold them to the end.
Okay, perfect. So I'm going to chat a little bit about then the federal government banning foreign buyers. So for those of you who haven't heard, the federal Liberal government plans to introduce a 2-year temporary ban on any non-resident who wants to buy a home in Canada. So, how big of an issue is foreign buyers in Canada? I mean, the interesting thing is if we look back to 2016, CMHC, our federal regulator, was arguing that this is not a problem, and in fact kind of put out a sarcastic jab because most people on Twitter that were agents or brokers were arguing it was something they needed to look into. So in their report, they actually said, to some, the scapegoat is obvious, blame foreigners. It's the recurring theme, the clear cause, according to the Twitterverse and many commentators. Foreign buyers was never the primary cause for rapidly rising home prices. I mean, it's just one of many factors. I was active on Twitter back then. A lot of people said the government needs to look at it. The government ignored it, dismissed it, pretended it's not an issue. But then several years later, once CMHC got some more accurate data from Statistics Canada, they actually found that non-residents own 11.2% of all the condos in Vancouver and 7.6% of the condos in Toronto. And that's a massive number because this is not 11% of sales. This is 11% of the stock of housing, which is far bigger than saying 11% of sales each year, right? So it's quite significant. So they were quite active, but the reality is around 2016, 2017, the BC government and the Ontario government introduced their own foreign buyers taxes. In Ontario, it was originally 15%. It's now increased to 25%. This has probably taken a lot of the demand from pure non-residents out of the housing market. The bigger issue is foreign capital flowing in. It's not so much like the residency of the buyer, meaning like where they live, if they're Canadian or not. It's really foreign money coming in. And even though the Liberals said that they were going to try to target foreign money, they're not. They're targeting foreign buyers. But like I said, with such high foreign buyer taxes in Ontario and BC to begin with, I don't see this policy having much of an impact in the housing market. I'm going to chat just very briefly about, some of the signs of financial stress we're seeing that's building. I mean, we've been hearing tons. I mean, if you're following the news, there's tons of headlines about stress in households. I mean, this is a chart showing 5-year mortgage rates, variable and fixed, since the beginning of the year. I mean, variable mortgage rates at the lowest were 1.5% at the start of the year, and have since exploded to, just around 5.5%. So this is a massive increase. This is weighing significantly on households who have variable rate mortgages. It's weighing significantly on households who needs to renew their mortgages now. If you had a fixed mortgage from 4 or 5 years ago and you're renewing today, your mortgage payment's probably going to go up 50-ish%, 40 to 50. So if your mortgage payment was $2,000, it's probably going to go to $2,800 or $3,000. And we're seeing from mortgage brokers say stuff like this, or this is sort of Daniel's a broker who said, as suspected, a segment of the prime borrowers of yesterday are slowly but surely becoming the non-prime borrowers of today. We're seeing a considerable increase in financing inquiries from homeowners with substantial equity that are experiencing financial distress. So again, this is, what we're talking about here is buyers who used to be able to get a mortgage from a regular bank are having a hard time and are going to secondary lenders for their financing. So again, we had a question earlier about financial distress and how this is going to impact the market. It's hard to say. I mean, there's two sort of theories about this. I mean, the most bearish commentators, the ones of the most pessimistic people, I mean, which tends to be on Twitter, I mean, I think assume there's going to be this massive wave of people defaulting on their homes, and this surge in inventory of homes because of that. Again, I think that's less likely. I'm not as convinced that that's going to happen for a few reasons. I mean, if you follow what's going on, policymakers are working with households to allow them to extend their mortgages now up to 40 years. So right now, the maximum amortization on mortgages was basically 30 years. And what the banks are allowing now, and especially mortgage insurers, is basically saying, okay, if you're renewing your mortgage now and you have this big increase, well, to soften that payment increase, what we're going to do is, rather than you renewing at the same mortgage cycle you're going. So if I originally got a 25-year mortgage 5 years ago, well, now I would normally need to renew at a 20-year mortgage. I needed to keep that payment sort of period. What lenders are doing and mortgage insurers are doing, okay, rather than renewing with a 20-year amortization and face a $1,000 payment shock, we're going to let you extend that mortgage out over 40 years or 30 years or 35 years so that your payment only goes up $200 to $300 rather than $1,000, right? So banks and insurers are working with households to soften that increase. So, and they're not just doing this to save households. I mean, certainly part of it is that they don't want people to default on their mortgage. But more importantly, there are, I think we chatted about this on our roundtable with Steve. There are, economic consequences if someone's mortgage goes up $1,000. They have $1,000 less to spend in the economy every month, which deepens recessions, which is what policymakers want to avoid. So not just about saving households, it's about avoiding a massive deep correction, because people's debt payments have accelerated. So again, and all this to say, I'm not certainly, I think we're going to see some households who are over leveraged. I mean, if a household has 4 or 5 properties and they're seeing their payments go up and their income properties, they're going to probably be pressured to start deleveraging, because again, like the more real estate you own, the more debt you own, those people are the most vulnerable. So we're going to see some distress probably among some households and some investors certainly. I don't know if it's going to be enough of a flood of inventory the way we saw in the US during the financial crisis to have a massive impact. But again, I mean, it's anyone's guess, I should say. So we'll see how that unfolds over the next 12 months, because I think that's going to be the most important period. So I'm going to wrap up by taking a closer look, and after this section, we're just going to take a few more questions. We're going to look at Toronto's rental market, because I haven't looked at some of these stats for a while, and I think it's worth exploring. So when we look at the number of condominiums leased in the Toronto area, we are below sort of the COVID levels, because COVID saw this massive boom, especially at the end of 2020 and the beginning of 2021, as people were kind of rushing back to the condo market. So we're below those COVID highs, but condo rental volumes are actually well above historical volumes if we take a look at that. I mean, for those who are on the webinar, not on the podcast, I mean, the current year is in red, but what we're seeing is rental volumes are quite high for condominiums. And when we look at the number of rentals for low-rise homes, they are at historic highs right now. And this current year is actually the record volume, because this is largely driven by the fact that at the beginning of the year, a lot of people just exited the home buying market and said, I'm giving up. These prices are insane. I'm just going to rent. So even at the start of the year, rental volumes were well above historical levels. And that has continued even up to now, largely because it's just too expensive for many households to re-enter the market. So they're just moving to the rental market. Active rental listings for condominiums are, in line with historical volumes. But in the low-rise market, where inventory levels are quite strong and quite high. But again, the market's still quite balanced because demand is very high. So we're seeing acceleration in the number of active listings for rentals. But again, the demand for low-rise rentals is high. And if we take a look at prices, I mean, prices have really skyrocketed since 2015. I mean, the average price for a low-rise home rental was about $2,000 in 2015. It's well over $3,000 now. Condominiums, was around $1,700, $1,800, and now is probably closer to 27-ish or so. And the condominium market did see a dip during COVID in rental prices. Again, a lot of this was sort of the exodus of the downtown core, but that has since rebounded. And when I look at, or if we look at condo prices or rental prices, I should say, comparing pre-COVID levels to today, we can, so looking at condominiums, condo rental prices are well above pre-COVID levels. Pre-COVID I've defined as February 2020, and I'm comparing that to November 2022. The areas in the suburbs, interestingly enough, saw the biggest increase in average rents. Durham was close to 1,900 and is now just over 2,500. So that's been the biggest spike. And it's interesting because, the suburban rents are really quite close to downtown Toronto rents, especially if we look at, areas like Peel, Mississauga. It's not that different in terms of average rents. And when we look at average rents for low-rise home prices, they have also accelerated since COVID and well above pre-COVID levels across all 5 regions of the GTA. And similarly with house prices and condos, and basically the suburbs saw the biggest increase, far more than the downtown city of Toronto. And the suburban markets, again, are at least areas like Halton. Halton's exceeding Toronto now in terms of average price, and York region is very close to Toronto. So rents are surging. Again, the average rent now is like I said, very close to just over $3,000 for low-rise homes, which is quite high. So I'm going to leave it there and maybe jump back to any final questions we might have.
We have lots of great questions. I'm going to group them. So hopefully we can pull out some themes here. So going back to Zaid's question, of all the things you've discussed, is there one systemic risk that you see above the others? Is there, for example, is it these investors that have second or third or other properties they might have trouble closing on? Could you see builders or developers, getting into trouble with their projects? Is there one thing that you're kind of keeping your eye on for 2023?
That's a great question, actually. I mean, so I wouldn't say normally it is investors more broadly. I don't think that's the case in Toronto because a lot of investors, especially of homes, have a ton of equity in their homes, right? It's not like most of them did not buy at the peak. Most have owned them for years. But I do think the one area where there is potential like broader systemic risk certainly is in the pre-construction condo market. Again, I'm not convinced it's going to be massive, but this is the risk because again, I don't know if it's going to be even a risk in the first half of 2023, but if rates stay high as we move like a year from now to the beginning of 2020, like the longer this high rate period lasts, and if prices remain soft, then you start getting into this point where like the pre-construction condos that are going to be closing a year from now or 18 months from now might not be worth what the investors paid for them, right? So you could start seeing more of the same dynamics that we're hearing about and seeing in the low-rise market in the pre-con market, right? And I'm saying, I'm not as convinced it's going to be a massive issue in the pre-con market this first half of the year, even though there's a lot of completions, because like I said, we've talked about earlier, most of the completions that are going to be happening, most of those people bought 4+ years ago. So the values have increased for many of them. So it's not like the low-rise market where, they agreed to pay 1.8 and now it's only worth 1.2 or 1.3, right? So again, I think that's, and when we talk about systemic risks, again, like we're thinking about bigger, massive issues. And this is like, people defaulting, the builder can't register the building because a lot of people are defaulting on their purchases. People stop making the deposits on their pre-con purchases that they're committed to. And again, if we look at historical downturns, like in markets like, Las Vegas, Miami, Dubai, that had a lot of investors buying pre-construction properties, these are the dynamics that happen. The moment things started to turn and slow down, buyers stopped making their deposits because they said, why am I going to make a deposit on an asset that's declining in value? Buyers couldn't close on their purchases. They couldn't get financing. Like these were the massive problems that those markets had. Again, it's hard to say to what extent we may or may not see that. Again, that's, we don't know, but certainly that's kind of the thing that we're keeping an eye on.
So building on that, I don't know if John Smith is asking this tongue in cheek, but will the government start offering free condos to citizens on a waitlisted basis? I'm assuming John means this outside of existing affordable housing programs, which are obviously massively oversubscribed throughout the GTA. But maybe a little bit more seriously, John, you've spoken elsewhere about 18,000 condo completion units, completions to be expected in 2023. Yeah. So between this combo of people who have bought recently, who may have trouble, getting that mortgage and have to sell quickly because they expected appreciation in these units. Is there a chance that we might see a lot of condo listings start to flood the market?
Yeah, I mean, very possible. And I should say, like, we might see some distress. Like the 18,000 scheduled completions is a stat from Urban Nation who basically said, or they're expecting over 30,000 for next year, but the bulk of those in the first half. So again, even if 10% of those have a hard time getting a mortgage default on their purchases, that's quite significant. So we might see some distress in that market. We might see people selling other properties in order to afford to close on their pre-construction purchase so they don't default on it. And yeah, we're probably going to see a wave of new rental listings. Like a lot of those condos probably are bought by investors. So we'll have to see obviously what impact that has on the rental market as well, because that is obviously a high volume of condominium rental listings, and we'll see what that does. And we might see, and that might lead to a little bit more stability in rental prices as we move into the new year, especially for condominiums. So yeah, I think we're going to need to keep an eye on those. But it's worth saying that these are the issues that governments can't do anything about. You know, when I talked earlier about governments and lenders and mortgage regulators helping households, extending amortizations, lowering their payments, like these are all things that they can do to soften the blow. But the government cannot save a wave of defaults. Like this is where it is what it is. Whatever happens, happens. Governments cannot do anything about that.
And John, say it just touches on your rental discussion. Is there a ceiling for rents, how high they can go? You talked previously about there being cash flow problems for some investors who have bought more recently and now can't recoup the rents that they would need to cover their current mortgage and other financing costs. But isn't there a ceiling? Like, and we've often heard the maxim that, you know, rents are tied to income way more than it seems like home sales are, given the mortgages and financing available.
I mean, 100%. I mean, there should be. And to your point, like unlike home prices, which, you know, the ceiling can be influenced by obviously interest rates and ability to borrow and take on debt. That's not the case for renting. So incomes should constrain rent prices. And I think we'll start to see that. But I think what's happening, what we're seeing now is that the rental dynamics are changing because rents are so high. You end up getting like two families try to rent out a house rather than one, right? And well, this now suddenly skews the sort of the constraint on income because two incomes, household incomes, living in a one home, you know, sharing spaces. So, and the same thing could be happening with condominiums. And again, I think this is the challenge we're facing in this market. And I talk about it frequently when I talk about how the population boom is skewing our market. Again, this is not going to prevent a decline, but when you have more people moving here than homes you're completing, this is what's going to happen. Like you're just putting so much pressure on the whole housing system that, you know, you get people sharing accommodations, sharing condos, sharing homes. I mean, until people get pissed off and think, I don't want to live like this, and then they just don't move to Toronto possibly, right? And then regardless of the targets the federal government, the provinces have, people just say, this is ridiculous, right? So, and, you know, and I think that's going to be the one challenge that we're seeing with rents right now, that people are sharing houses and condominiums, which is, you know, making them in theory more affordable, but people have smaller spaces.
Oh, it's interesting. So a lot of challenges to how we're traditionally thinking. Some of these rule of thumbs could change because of the extreme conditions that our market's in. So that's interesting. I want to go to a question that Frank emailed in. Phil Soper of Royal, I think this is Royal LePage.
Royal LePage, yeah.
Predicts sales to rise in spring of 2023, leading to the start of a potential upswing in the market and a slow rebounding of house prices. So that would be quite early, I think, John, based on what others are saying. How likely is that in light of where rates are today, or could even possibly be higher in the spring?
I mean, so I hate criticizing other people in my industry, but okay, listen, sales will be higher in the spring if we're comparing them to the fall. Okay, sure, that's a seasonable dynamic if that's what he means. I don't think that's what he means, but you know, sales are going to be way below last year's volumes, and they continue to be at historic lows. And again, the problem is going to be affordability. Like the prices are so high, given that people are qualifying basically at a 7% mortgage rate, right? So I don't know. I don't see a massive sales boom or increase. Like I do think it's going to be busier than it is now, because you're always going to have people who need to move, relocating. They're having, you know, another child. They need more space. So we're going to see more demand. I don't think it's going to be a crazy market. Like I don't think we're going to see a flood of you know, a big surge in sales, but it's going to be busier probably than it is today. The unknown is going to be like the listings volume, right? The new listings volume. And that's ultimately going to dictate, to me, as far as I'm concerned, what happens to prices, right? If listing volumes stay constrained, which is the way they've been since July, prices are going to stay flat. Like at the end, like it's not, I don't think we're going to see a massive decline. I mean, we need, I think, more inventory, more distress from sellers, more sellers desperate to get out or whatever it is, and their homes aren't selling, to see more downward pressure on prices. So I'm not as bullish as Phil. Like I'm not as pessimistic as some of the housing bears, but I'm not as bullish as Phil is.
Okay, well, a question from Riaz kind of highlights how those that are in the industry, realtors and others, have a bit of it's a challenging time, right? So Riaz asks about how we should be looking at numbers. Should we be looking more at month-to-month appreciation rates rather than year-over-year appreciation rates when thinking about where the market's going? Riaz goes on to say that's because in the first quarter of next year, we'll see obviously year over year reflect a huge drop in prices. Would this be overstating the case? I'm paraphrasing what he's saying, and scare people too much. And is it more important to watch the month-to-month momentum and trends of which direction the prices are going in?
That's actually a very good question. And I think, again, I think this is where a lot of agents, I would say the ones that are trying to skew the data for a long time were focusing on year over year statistics, right? Like especially up until the summer and September, October, because the year over year statistics were positive. Prices were still up, or if not flat. But they were ignoring the fact that the average low-rise home was down 400 grand in like 5 months, right?
Right. So they were focusing on the year over year because that was showing the smaller decline, but the trend was moving negative.
Yes. So I do. So the answer to that question is I tend to think the more important thing that we should be looking at is indeed the month over month dynamics, because year over year is going to kind of be very messy for the next 9 months or so, because the point is correct. I mean, that by February, the year over year decline in prices is going to keep getting worse until we get to February, which was the peak, because we're comparing today's prices against the peak of the market, and that will be like 23%. But if prices stay flat, that's not news. Like that decline happened 6 to 9 months ago. Prices have been flat since July, right? So what we want to look at is how are prices progressing on almost like a month over month basis. And of course, taking some of that with a grain of salt, because there's seasonality in house prices, right? Which is why we normally don't look at month over month. But even with the seasonality, prices have been pretty much flat since July, which is a more interesting dynamic. And it's interesting again, because I think a lot of people aren't appreciating this. The decline we saw at the beginning of the year was not about financial distress and all of the high household debt levels, which is the thing that most economists and macro people expect is going to drive down house prices. The decline was just purely it was behavioral. It's like the increase in rates spooked buyers pulled out of the market. The sellers were caught in 2 transactions. They bought, they needed to sell. So the moods turned pessimistic. Prices started declining because sellers had to sell. It doesn't matter, because they committed to buying another home. Once those people who were caught in 2 transactions sort of filtered out of the system by June, July, prices have stabilized. So we have yet to see a decline from these traditional recessionary high household debt, high payments, people can't afford them, they're deleveraging, all of these things. And this is where I think we need to look sort of month to month is going to be more important. Even like listings volumes, sales volumes, I still look at them week to week, quite frankly. Like I look at them just because I think when things are moving quickly, you don't notice them if you're looking at monthly data. And it's like these rapid changes in sentiment and price dynamics that I think are more important. So for the next like 9 months, I think the month over month dynamics are more important. And I say 9 months because once we hit like July 2023, well, at that point, we're comparing against what has been sort of a flat market, like price has been flat for 5 months or so. So we're going to be comparing against sort of a period of stability, which is a little bit more normal. But over the next month, we're comparing this like this cyclical market where prices accelerate up to February, declined in the second half. So I think it's going to be more critical to look kind of month over month over the next 6 to 9 months.
Interesting. So we've got a number of interest rate questions, so I'll just group them.
Sure.
The top line is, where will the Bank of Canada go next? When might they start to pivot? So we saw last week that the BOC actually raised by 50 basis points. Some people were expecting 25. So that was a bit bigger than expected. I believe the market was expecting 50 points though. Is this it? Shrikant is asking, we haven't seen these kind of rapid increase rises since the 1990s. Is the pivot soon? In other words, everyone's just wondering, how long can this go on?
Yeah, I actually think we haven't seen these probably since like the 30s, or like we went from virtually 0%, like 0.25 to like 4.25 in the span of like 9 months, which is like unprecedented in terms of the speed and the magnitude. Where they're going, I mean, I think most macro people are probably expecting, it looks like they're going to probably not pivot, but stay where they are. We might see another quarter point increase, but I'm not hearing many people predicting like way more rate hikes. Like I think especially, inflation was below expectations in the US the last week or this week, I can't remember, a couple of days ago, which is a positive indicator, right? So if the banks start seeing that today's interest rates are having the desired effect, and I think Tiff Macklem came out and said they are, I think they're just going to wait, and they're going to wait for the interest rates, these rates, to work through the system to kind of, drive inflation down a little bit. I don't think they're pivoting, and by pivot, I mean, I don't think they're cutting rates anytime soon. If they do, like the end of next year, maybe the earliest, is kind of what I see most people predicting. So I think we'll probably have high rates for a while. Now, what the Bank of Canada does, and again, what the bond market does, are different. So 5-year mortgage rates are driven by the bond market. And those might change over years. Again, if the bond market is predicting, more rate cuts later this year, we might see 5-year rates decline sooner. But again, I don't think we're going to see any massive changes over the next little while. And that's partly why the market's going to stay sluggish.
Well, thank you. Okay, I'm going to wrap up with our last question so everyone can maybe eat a bit of lunch. We were talking about this on our roundtable with Steve. That roundtable can be viewed on our YouTube channel, and also our podcast has that episode. And so I'm going to close with Conrad's question here about whether there is this buyer opportunities, basically. Is there a specific segment of the market that an investor with cash would be best suited to target in the next 6 to 12 months? So is there any opportunity amidst all this dismaying news? So
number one, prices are so high still. Like, I don't want to make it sound like there are great opportunities. Especially if you're looking at either condos or triplexes or whatever it is, the challenge is that, when you look at the high prices and you look at your interest rates, it just doesn't make sense. When we look at the cap rate for investment properties, and the cap rate, if you just think about it, is like, how much money am I making given the purchase price, right? It's almost like the interest, if you want to think about it like that, right? After expenses. So, if your cap rate is 4%, and you're paying 5.5% on your mortgage, I mean, it's a very difficult position to be in, because the return on your property is below what you're paying on your debt, right? So this is what makes investing right now very hard. That being said, some of the opportunities that I have seen that, I mean, I'm not in a position to buy these types of properties right now, but quite frankly, some of them that are more development type, and I don't mean like big farmland or anything like that, but lots in the GTA that are a good fit to be built or split or severed, like wide lots, big lots that are dumpy houses that have the potential to be redeveloped. Those, I've seen some very low price and thinking, oh my God, I wish I could have bought some of these, because there aren't a lot of people buying those right now, right? And there aren't a lot of people buying them because, you know, you're buying a property for whatever it is, $1 million or 1.5 or 1.8, that you're going to potentially redevelop in the future. And not a lot of people have the money to do that now and wants to invest and build and get financing in such a tight and expensive market in terms of financing. But certainly some of the sales that I've seen, like those people are going to make a killing in 2 or 3 years because they've been sold kind of below what their real value is, especially if you're looking at properties that have the potential to be severed into 2 lots. And I think that's the one kind of space where I've seen that. But aside from that, most are very hard. And again, that's in the GTA where I kind of focus on. Like if you're looking in the outskirts, maybe there's more potential, but the GTA is still very expensive given the rental income.
Looking at Toronto specifically, John, there's also a motion before City Council to maybe even allow even more densification on these kind of lots. So yeah, and that might be something to.
That's a good point. And I think this is potentially where there's potential. I mean, you know, so what Urmi's talking about is the City of Toronto is trying to encourage more density by allowing more homes to be converted to triplexes or even fourplexes more easily with less red tape, fewer barriers. That might be an opportunity from an investment perspective because, you know, typically when properties are upzoned, meaning, you know, we go from a policy that only allows a single family home on this lot to allowing 4 units stacked on top of each other, like a fourplex. Well, that completely changed the economics of that lot, right? And that might be an opportunity for some people who want to invest. But again, that's kind of what I'm saying is like buying land effectively is what you're doing, right? And you're building and becoming so those are potentially the opportunities, but most investors aren't in that game. Like if you just look at it, they don't have the experience, they don't have the capital. And to do that, you have to have, I'd say both, because it's a bit riskier than just buying a pre-construction condo.
Yeah, not sure. I'm not sure I have the guts for it, but interesting. Okay, great. Thanks to everybody for their questions. That's our time today. Keep your questions coming. You can message us on our YouTube channel, Move Smartly. And in our show notes to this, you'll see a contact for John personally. And as always, if you have feedback for the show, you can reach me at editor@realosophy.com. Or is it editor@movesmartly.com? I think I need a vacation, John. So on that note, it's just left for me to wish all of you happy holidays, to thank you for joining us, and that we'll look forward to continuing this live session in the new year. Thanks, John. Great. Thanks, everyone.
Thanks, everyone, for your questions, and we'll see you in the new year.